Okay, so let's take a look at some questions related to bonds, specifically bonds payable. These bonds are liabilities, and we kind of give them their own chapter because for many large corporations they are such a large source of liability, and they have some pretty unique characteristics. So let's go ahead and take a look at some true-false questions to kind of get us started. It says here, bondholder claims on the assets of a corporation or of the corporation rank ahead of stockholders. So what we're talking about here with this true-false question, we could probably add to, in the event that the company go bankrupt, who would have first claim on company assets? Would it be bondholders or stockholders? Well, we need to understand that bondholders, okay, are equal to creditors, okay, and stockholders are equal to owners. So this is a true statement, but I want you to understand why. We must pay off our creditors before we can pay off the owners of the company. Otherwise, what we would have going on is we would have unscrupulous business owners going out and borrowing tons of money and then just declaring bankruptcy, selling off the company assets and paying off themselves for whatever investment that they have first, and the creditors would never get paid that way. So this is a statement. Second question here says, when a corporation issues bonds, it executes a contract with the bondholders known as a bond debenture. Well, this is actually almost right, but instead of debenture, we want to call this a bond indenture. A debenture is a type of debt in and of itself, which is actually similar to a bond, but the contract that we're talking about right here is actually a bond indenture. So this is going to be a false statement. Okay. Face value. The face value of a term bond is payable at a single specific date in the future. So a lot of things going on here. We've got a specific type of bond, a term bond. Most bonds are term bonds. And we're talking about a single date in the future. What they're getting at here with single is they are trying to differentiate a term bond from what we call a serial bond. Serial bonds have multiple maturity dates. So let's say that we have a 10-year bond. Well, 10 years is the term of the bond, and the bondholder is going to collect interest, usually every 6 months, but at the end of the 10 years, at the very end, which 10 years from now will be in the future, they're going to get a single payment to pay back what they invested in the bond in the first place. So this is a true statement. A bond is simply a form of an interest-bearing note. This is essentially a true statement. If we think about it, when we go and borrow money from the bank, we are taking on debt. Okay? When we issue bonds to investors, they become creditors. We could be said we are taking on a debt to those creditors. And most bonds, we sell a bond for $1,000. We get the $1,000, and then we pay interest, and then we make a lump sum payment to the bondholder at the end. So it's different from a regular note payable in the sense that most note payables are installment notes of some kind with either monthly or annual payments. A bond is different in the sense that we pay the face amount all at once, and then we make the interest payments usually every 6 months. But this statement is far truer than it is false. Okay? Right here it says the interest rate specified in the bond indenture is called the, and then we have discount rate, contract rate, market rate, and effective rate. So in the PowerPoint lecture, I told you that if you've taken another class and you've been told that the interest rate and the discount rate are the same thing, that was good information and it was true, except when talking about bonds. And as we get further into the discussion on bonds, there's a reason why we don't use that terminology, discount rate. So with bonds, we use the term coupon rate for interest rate, or more commonly, contract rate. Okay, contract rate, coupon rate, and interest rate are all synonyms as they pertain to bonds. And again, contract rate is going to be the most common of those terminology. All right, let's straighten this out a little bit. All right, so it says right here, if the market rate of interest is 7%, the price of 6% bonds paying semi-annually with a face value of $500,000 will be, okay, and we need to determine whether it's equal to 500,000, greater than 500,000, less than 500,000, or it just depends. So let's read the question again. It says, if the market rate of interest is 7%, the price, the sales price for these $500,000 in bonds that are paying 6% interest will, with a face value of 500, be equal to 500,000, greater than 500,000, less than, and then it depends on the maturity rate of the bonds. So what we learned is that there's an inverse relationship between market rate of interest and bond price. And if we didn't learn that, we need to learn it pretty quick. So when market rate is higher than the bonds, which is the case we have here, 7% market rate of interest for similar bonds, our bonds are paying 6%. So when the market rate is higher, the bond price goes down. We have to discount the bond, okay, to make up for the fact that we're only paying 6% interest when the going rate is 7% interest. This is also why we don't use the term discount rate with regard to bonds, because it can become confused with a discounted bond. So the answer to the question, given this scenario, is going to be choice C. We're going to get less than $500,000 for these $500,000 in bonds. So yeah, we get less than $500,000 when we sell them, but we're also saving a little bit of money every time that we're not having to pay the 7% rate of interest. We're paying 6% instead. So it kind of works out for us. Bear with me 1 second. All right. It says here, when the market rate of interest on bonds is higher than the contract rates, the bonds will sell at a, well, I use the terminology in this question right here. So market rate of interest is higher than the contract rate. Well, that's what we have right here. 7 is higher than the contract rate of 6. So we're that up here, we're going to get less than 500,000. We would say that these bonds will sell at a discount. And again, I kind of just gave you that answer a moment ago anyway. All right, let's see what else we have here. All right, so I'm looking at this question here. It deals with the straight line method, and I don't want to confuse the issue, so we're going to go ahead and just this question, and this will be the last multiple choice question that we did. That'll be the last question for PowerPoint slides 1 through 13.